Today, we will talk about distributable net income, DNI. Distributable net income refers to income allocated from a trust to its beneficiaries. DNI is the maximum amount received by a unitholder or beneficiary that is taxable, to prevent double taxation. Anything above the DNI is tax-free. The IRS considers DNI to be an estimate of the economic value that stems from a distribution to a beneficiary. Estates and non-grantor trusts must file income tax returns. The income is taxed at either the entity or beneficiary level. When calculating the distributable net income, any capital losses replace the capital gains and are added to the formula. To calculate the taxable income, you need to add interest income, dividends, and capital gains, then subtract any fees and tax exemptions. Unlike the DNI calculation, capital gains are added in the taxable income formula while capital losses are subtracted. DNI is the income distributed from a trust to its beneficiary, while net income is used by a business to calculate its earnings per share. Net income is the total profit of a company divided by the number of outstanding shares of its common stock. For example, if a trust reported $40,000 in total income, with $10,000 from interest income and $30,000 from dividends, with fees of $3,000, and a capital gain of $15,000, and an exemption of $300, the taxable income would be $51,700. Then, the DNI would be $37,000. A trust's taxable income includes interest income, dividends, and capital gains, and it subtracts any fees, tax exemptions, and capital losses. For the DNI calculation, capital gains are subtracted back out, while tax exemptions and capital losses are added back in. Distributable net income excludes capital gains and losses. It is removed from the taxable income figure for the purposes of calculating DNI. In 2022, a decedent's estate is allowed a $600 exemption, a trust required to distribute all income is allowed a $300 exemption, and a qualified disability trust is allowed a $4,400 exemption. All other trusts are allowed a $100 exemption. Here are 4 key takeaways. 1. Distributable net income is income allocated to the beneficiaries of a trust. 2. This figure is the maximum taxable amount received by a unitholder or beneficiary. Anything above that figure is tax-free. 3. DNI gives beneficiaries a reliable income source while minimizing the amount of income taxes paid by the trust. 4. DNI is calculated using the trust's taxable income, subtracting the capital gain or adding the capital loss, then adding the exemption. Hope this would help. Thanks for watching.